Last month, I made $5,822 across 2 brokerage accounts in 30 days. I made one buy across the entire month. I'm not a day trader. I didn't try to time the market, and I didn't get lucky on some meme stock. In this video, I'm going to break down exactly what worked, what didn't, and lastly, at the end, I'll show you a psychological trap that costs the average retail trader 6.5% a year, and how I avoided it without even trying. If you enjoy long-term investment videos and want to learn great strategies, tips, and advice, subscribe to the channel. I post at least 5 videos a week on those subjects. Now let's get into the topic of this video. Last month in April 2026, this is exactly what I did to earn that $5,822. The total time I spent managing these accounts was maybe 1 hour across the whole 30 days. Now, an important caveat I'm going to come back to at the end is that most of that is unrealized profit. That means I didn't sell it, so that means it's still exposed to the market and it's not cash. I could sell it now and realize those gains, but I want to stay exposed to future profits. And you have to understand as well, of course that can drop, but the point is it's unrealized potential. And the point is, I could sell it now if I wanted to, or keep it for more at a later date, or less potentially. But for that 1 month with the activity I described, I'm going to show you exactly where every dollar came from. First, on eToro, I had price appreciation of $4,425. On IBKR, I had price appreciation of $1,396. eToro is more because I hold more there and it's an older account. My IBKR is quite new, and I have a little bit less in there. So 99% of that price appreciation was due to stocks I already bought or once held. The rest was some small increases in dividend payments. So dividend yield, it's a hyped up thing, but I didn't really get that much from it this month. However, if you do focus on dividend investing, it can be quite lucrative. In my case, mine was more exposure to stocks and ETFs, less about dividend chasing. So with that in mind, let me now show you the stocks that did the heavy lifting and which ones dragged. 4 positions did almost all of the work for me this month. First was TSM, Taiwan Semiconductor. I have this on both accounts and it was up about $250 across both of those accounts. The AI infrastructure thesis is still running and still growing. Every chip in every data center passes through Taiwan Semiconductor's foundries. I bought it, I held it, and it paid me. Nothing smart, nothing clever about that. Next was VTI, Vanguard Total Stock Market ETF. This was up $605 on IBKR and was one of my single biggest winners. For a beginner investor, this is a great one to invest into. They have exposure to basically all of the US stocks in their portfolio. Next was Coca-Cola Consolidated. That was up $114. The bottling infrastructure that prints cash, whether the market's up or down. Warren Buffett would approve. Next was Oracle, up $157. And Oracle is quietly becoming critical infrastructure for AI workloads. If you notice the pattern here, mega cap quality and a broad index did all the work. Nothing exotic, nothing speculative, nothing that required me to be smarter than the market. And if you took just these 4 positions and ignored the rest of my portfolio, then my month would have been way better than the numbers I mentioned at the start of this video, because I want to also show you what didn't work for me and what dragged that down. First of all was Palantir. That was down this month. Unfortunately, I bought into that hype near the top. The company's great, but the price I paid for it wasn't. Next was Gemini Space Station, GEMI. Again, I bought this at the peak of IPO, and that's bad, but what is worse is that they fell into all these lawsuits and regulatory problems. And I really just bought into the hype of it based on the founders. And that one is one of my biggest losses at the moment. I put it as a speculative bet, so I didn't put too much into it, but honestly, I'm 80% down on that one. Next was GlaxoSmithKline, GSK. That was down this month due to drug pipeline concerns weighing on it. But I believe in the long-term thesis of this one. And then the other one that was down was my recent investment into Grab. But that was just a fresh investment. And I think this one will play out quite well in the long term. The thing that I want to learn from is that the speculative story-driven narratives and buying things at the peak overvaluation. I studied a lot more about valuing stocks, and I've gone into that in other videos on this channel. But I learned a lot from that process, and that will help me in the future to avoid getting bought into this hype cycle. Now here's the part I actually want you to really remember, the biggest takeaway is a psychological thing that I want to get into. There's a study every investor should know about. Researchers analyzed hundreds of penalty kicks in professional soccer because they wanted to know what goalkeepers should do and shouldn't do. Here's what they found. Goalkeepers just dive left or right 94% of the time. They just do that and hope that they'll catch it. It's not that they know it's going left or right, they just commit to jumping one of those ways. However, the ball tends to go roughly in the middle a third of the time. So mathematically, the optimal strategy is just to stand there. So why don't they? Why do 94% of them dive left or right? Because diving the wrong way and missing feels better than standing still and missing. Action feels like effort. Standing feels like failure, even when the math says it's the right move. Psychologists call this action bias. Your brain is wired to confuse activity with progress. Doing something feels productive. Doing nothing feels like you're falling behind. And there's a famous study by two finance researchers, Barber and Odeon, that put a number on this for investors. They tracked thousands of retail trading accounts for many years, and the result was that the most active traders underperformed the least active by about 6.5% per year. 6.5% compounded over a decade is the difference between getting rich versus working forever. Instead of micromanaging everything on a day-to-day basis, let the long-term thesis play out. That's what long-term investing is about, not day trading. Because if I'd been active in doing what I felt to be was productive, I would have sold, for example, Taiwan Semiconductor at a small gain weeks ago before it ran another 17% up. I maybe would have panicked on VTI about a bad headline. Maybe I would have doubled down on Palantir because of the losing position. I didn't beat the market because I'm smart. I beat it because I stayed out of my own way. And really the hardest part of investing isn't about picking your own stocks. It's about standing still and being patient while your brain is screaming at you, move. And I hope you got value from this video. And I look forward to seeing you in the next ones. Please subscribe. I post at least 5 to 7 videos on this channel for long-term investors.